major stumbling block was getting the shareholders to agree to the transaction. With such a dispersed pool of capital, with a lot of retail investors who had lost a lot of money and didn't really understand or don't really accept that shareholders stand at the bottom of the capital structure and should take the first losses. The major risk was getting this deal approved in a shareholders' EGM.
The key to a successful investment in this case, which in this instance we're still very early in the process, but is both financial and operational, so both financial and industrial. I think when it comes to the industrial, the underlying principle is to have the appropriate governance and making sure that we would be able to further down the line implement the changes that were needed to ultimately make this a successful investment.
A significant increase in the number of debt equity swaps in the French market. When I say significant increase, I think, happy to share views, Arnaud, but I think probably in excess of 2/3 of the deal we've seen in the past 2 to 3 years took the form of a debt equity swap.
It is very difficult for a listed company to share any of its prospects with future equity owners, because it will have to cleanse that investor vis-a-vis the rest of the market, and it's very unusual for a listed company to publish a business plan. So there's always a phase of negotiation as to which level of detail will be granted to the subpar investor and future equity owner, and therefore what exactly will be cleansed to the broader market.
The concept of deep financing has still some way to progress in France. And what we have seen in this instance, I think, is that it is most of the time very difficult, if not impossible, to implement, depending on the structure, obviously. But most of the time, it's a tool that is not, as widely used and available as in other jurisdictions, and certainly something we can work on and reflect. One point that I find interesting in France is that it's probably one of the only country, if not the only country, where I've seen the super senior part being the most expensive. It's meant to be the lowest risk part of the cap structure, and we've seen a lot of restructuring where we end up with super senior new money being like double digit type of, so 10% plus yield, which is obviously very expensive for the company and makes no sense economically because it turns out to be more expensive than the regular senior debt.
We talked about shareholders earlier, but I think we didn't speak about junior creditors who are out of the money and who can absolutely block you a process because they vote in a separate committee. Cost is higher, you tend to protect yourself much more on the downside and leave more debt on the balance sheet and therefore put new money more under the form of super senior as opposed to equity.
The major issue, which is the one that Laurent, you touched upon, is that the French law distinguishes bank creditors and bond creditors and doesn't distinguish senior lenders and junior lenders. And it would make much more sense to stop having this crazy split between bonds and banks and have different classes of creditors according to ranking. Because then you could probably give a lower weighting to the junior creditors in any vote, and that would make things easier, or try and approach value.
But I would say for the occasional investors, that is still useful to the country, to the industry, because we just obviously need to appear as creditor friendly, generally speaking. There is an issue if we don't have a valuation based framework that can be used as a reference and essentially give enough predictability to make this a creditor-friendly jurisdiction.
Now, what would help is effectively to have a binding mechanism within the law that effectively puts that valuation recognition in practice, and as a binding mechanism to effectively be able to force a transaction on an out-of-the-money stakeholder who will block or keep hostage a process.
All the private equity type restructurings are probably behind us. There may be a new wave, but in the short term, I think we all see more corporate companies going for restructuring, which will be very, very complex compared to the wave that has been seen, either because these companies are listed or because they're owned by entrepreneurs and not by professional private equity funds. And also because they're more and more financed by bonds. Major issue is that bondholders may be treated as a separate class from bank creditors, even if they are more senior than the banks, and even if there's no reason to treat them differently from the bank creditors. So you can't even, in a structure where you would have essentially bonds and a very small part of banks, you can't cram down the banks.
What is the actual intention of an insolvency law? Is it to preserve the status quo and extend and allow extensions of debt and to preserve jobs, whatever that means? And nobody's actually come up with a proper definition of that from my perspective. Is that the objective, or is the objective to help the process of creative destruction, where we actually get the loss taken and we get the company which is allowed to move forward with a healthy competitive balance sheet?
Reflecting on what has been said, I think the recognition that wider cram-down tools are required, one we can use earlier in the process, one form or another, are going to be key to keep a healthy process going forward. That would be one. I think the second is the unconditional recognition of priority within the cap structure, because again, whether it's secured versus unsecured, or junior versus senior, we're more an exception than anything else in France today, and I think that needs to be clearly addressed to progress.